Okay, very good evening. Very good evening to my dear future chartered accountant. Uh, First of all, can you please confirm that my voice is clearly audible? Is my voice is fine? And are you able to see the PPT? Can you please confirm it once? Okay, audible. Very good. So this is, as I mentioned in the messages, this is the first class in my regular SFM batch, derivatives. We have done with the chapters such as portfolio management, mutual funds, valuation, and so on. This is my first session on derivatives because many students have asked me that our basics in derivative is lacking. I thought, why don't I share my introductory video to everybody? Anyway, some states like Karnataka is in lockdown or some cities. So instead of thinking about something else, we can focus our energy in a positive manner. The basics what we learned here will be useful definitely for exams, required for conceptual understanding, and if you can apply these things well in practical life, maybe you can do trading on your own without any help, just online, and just understand knowledge, nothing else, more analysis. You'll be able to do well with respect to the market is also concerned. Just a quick recap how we have come so far in our regular classes. We started with the basics, time value of money, averages, and so on. Then we started with the valuation on bond valuation, fixed income securities. From bond valuation, we moved towards share valuation, where fixed income security became variable income securities, where we understood various valuation mechanism like P ratio, FCFF model, right shares, bonus shares, and so on. And then from the bond to the shares, we move to combination of shares. That is what is called as portfolio management. And that also we understood various kinds of theories associated with a portfolio. Simple theory of portfolio: don't put all the eggs in same basket, right? Diversification. And then what is the way which individual people, public can invest in a portfolio through the market? That is called as mutual funds. That was our previous session. So bond valuation, share valuation, portfolio management, and then mutual fund. So we are understanding, we are going in a logical sequence. The next one is derivatives. As the name suggests, derivative, the value is deriving from some other asset. So derivatives, why it is so difficult? What are the complexities involved? What are the basics terminology you have to understand, like long, short, shorting is where many people have many confusions. So things on those things, like what is arbitrage, what is exactly options, what is exactly futures, again fundamentals. We are not going too much in depth because this is our first session on derivatives. If you are a person who knows derivative, well and good, no problem. But the objective of this exercise is to lay foundation, very, very basic, without complicating much. And as and when we understand little bit concepts, I will go to the websites. We'll see the share prices, and we'll also see the derivatives like option prices, future prices. Today only we'll see that. And basic interpretation also we'll be doing it. And for those, our students anyway, I'm doing from basics. For others who are joining for the basics, is there any specific requirement of yours so that I can comment whether I will cover the topic today or not? My objective is you should not spend the time thinking differently what you get and what I provide. If it is different, your time is not justified. So is there any specific topic that you are looking in this session? Because if that topic is not covered by me, I'm going to tell now itself, you can take the decision. Because after spending the time, you should not feel bad that, oh, I thought this is going to be the session, but he told something else. I don't want to disappoint you, my dear friends. So, is there any specific area that you are looking for in this session? It's a foundation on derivatives. Still, is there any terminology? Is there any area that you are specifically looking for in this segment? If it is there, please comment. No specific area? No problem. Very good. Let us understand derivatives from the basics. Because all of us will understand cricket, and let me start from the example of cricket. I'm getting one spread strategies. One thing I will make it very clear, I'm not covering strategies today. I don't even talk about the strategies today. Objective of this is only to make your foundation stronger. So spread, straddle, strangle, butterfly, iron condor. No, I'm not covering any strategies. Okay, so since we all love cricket, in India, cricket is the biggest religion, and of course, Sachin is our god. I thought, why don't we understand from the point of view of cricket itself about the derivatives? Yes, basics is what I'm going to handle. Yes, basics what I'm covering it. Okay, let us understand from the very basics. Let's say there is a cricket match, and one person who is watching the match want to make some profits apart from just utility, means apart from just watching the match, he wants to make some monetary benefits. What is that? He thinks that match Sachin is going to score a century. There is another person, you know, your friends will always be there who is always against you, or people who are always not in the same opinion as yours. People always need to have conflicting opinions. That what makes any group, friendship, life, country more interesting. Even stock market, if you don't find a person with opposite expectations, what trade can you do? You want to buy the shares. If seller is not available, you can't do anything. Stock market similarly, you want to sell the shares, somebody else should be there to buy the shares. We always need people with opposite interest. So you think that Sachin is going to score a century, and another person thinks that he is not going to score a century. So there is a conflict, there is a difference of opinion, and they, let's say they want to bet. Now, derivatives, is it about betting? Hold on your thoughts. Derivatives can be used for many purposes. One of the purposes is betting, or in financial management, it is called as speculation. I repeat the sentence. Derivative can be used for many purposes, but all purpose cannot be understood simultaneously. You have to understand one by one. So one of them I'm taking it as a sample for illustration purpose. So don't think all derivative is about gambling. No, it can be used as speculation, but it is not only about that. To understand, I'm starting from basics. And what is the bet? The bet is rupees 20. Now, if Sachin scores a century, if Sachin scores a century, what will happen? The person who said he will score, he will get 20 rupees. That is a profit for him. And the person who said he will not score century, he will lose. That is a loss for him. Now, if Sachin does not score a century, then what happens? Then it is a loss for the person who told he will, and for the another person who told that Sachin will not score a century. His expectation became true. He has won the bet and he will receive rupees 20. So this is a fundamental betting game to understand from the scratch. One person who wins gains, one person who loses lose money. So that is the foundation principle of the betting game or any transaction. Okay, this is first point. Now let me change this in a slightly different manner. Same match, same two persons, same Sachin Tendulkar scoring a century. But I will make a small modification. I will make a small modification. What is the small modification? I am going to do like this. There is a cricket, two persons, and bets that one person that the Sachin Tendulkar will score a century. And what he says, not just a century. He is even more confident and says that I I know he will score 100. Not only 100, every one run he scores above, you have to pay me 1 rupee. If he scores one run below, I will pay you 1 rupee. So previously it was a only binomial situation. What? Either you pay 100 or you'll get 100. Only two situations. 100 comes or 100 goes. That was a two type situation. Only binomial model situation. But here what we are looking, multiple situations. Over and above 100, how much he scores, that much I get. Below 100, how much he does not score, that much I lose. Okay, now if you understand, if Sachin Tendulkar scores 90, then the person who bets, he will lose 10 rupee. The person who said he will not score, he gets 10 rupee. Why? Because 100 was the bet. He scored only 90. So what is the shortfall? 10 rupees. So your expectation is different. You lost by 10 runs. So you lose 10 rupee. Another person will gain 10 rupees. Now, if it is 100 rupees, on dot 100, exact 100, that means you don't have to pay anything and he don't have to pay anything. That is no profit, no loss. Because you have to pay only if it is below 100. He will pay you only if it is above 100. At 100, then you need not pay anything. 105 means 5 rupees over and above the 5 runs over and above the bet runs. So how much runs Sachin Tendulkar scored more? 5 runs more. So how much you get? You get 5 rupees, whereas other person has done an obligation that I will pay you rupee for above 100. Now he scored above 100, therefore he gets 5 rupees. He gets 5 rupees. Not minus 5, he gets 5 rupees. Just 1 second. Yeah. So he gets 5 rupees. Now, if it is 120, can you people tell me how much will be the profit for this person and how much will be the loss for another person? Can you tell me if it is profit 120, if Sachin Tendulkar scores 120, how much the first person gains or loses, how much the second person gains or loses? Because the bet was for 100 runs. He scored 120 runs. Therefore, yes, the first person gains 20 rupees, second person loses 20 rupees. So you understand this, my dear friends? Now, is this one person's profit is other person's loss? In this case, the answer is yes. But it is not a binomial situation, because depends on how much run he scores, your answer can vary. For every one run, one rupee. One run more, one person gains more. One less, one person loses 1 rupee, and opposite for another person. So this is not a binomial situation. Multiple possibilities, multiple probabilities exist. This is called as futures. This situation of betting a number is called as futures. Now, to be called as derivatives, certain things are there. We will address it one by one when we take the individual derivatives. But at this point in time, try to understand, whenever there is a future, there has to be a future price. In this case, the future price is 100. And every future is bound by an expiry date. Expiry date means what? Within this period only it should happen. Like if this is the example, cricket match, at the end of this match only we should consider. We cannot consider next match and so on. And it is to be bound by certain rules and regulations. So this is just a introduction I'm giving you. Just try to get a framework in mind. We will discuss one by one in detail, slowly, but effectively. Don't worry about it. Okay, so did you get the basic concept of futures right? Means if it is used for speculation purpose, one person's profit is other person's loss, but it is not binomial in nature. The profit can be any number, the loss can be any number. As the person scores more runs, one person gains, other person loses. As he scores less runs, one person loses, another person gains. Are you able to understand the two sides from a single transaction perspective? And there has to be a contract. We will understand more futures, more details about calculation of futures, formulas, how do you make long, short, all those things I'll come to it. But my objective is to make your foundation strong, because anytime, next time you get a confusion in future, try to remember this cricket example. So you'll be easily able to compare it. So I'll give you 5 seconds. Think about the example I've given you. Let me know if you have any question you want to ask based on this example. And whatever comes to your mind, try to summarize. Oh, there are two parties. There is one person. There is one betting amount. It can increase, it can decrease, whatever. Whatever comes to your mind, try to arrange your thoughts. I will not force fit any thoughts into you now. I will force fit when I start discussing futures at a later point in time. Just try to summarize the thoughts in your mind. And in that process, if you get any doubts, you can ask me within this framework, within this example. What is binomial example? I gave you the previous example. Binomial means only two possibilities. Either you get or you don't get. Either you get or you don't get. In the previous example, if he scores, you get 100. If he does not score, you don't get 100. As simple as that, right? That is binomial in nature. Binomial means only two outcomes. The head tail. Win lose. 100 minus 100. Only two possibility. Things like that. What happens if match is abandoned? That is, what if the contract is cancelled? What if rain comes? If rain comes, will the spectators get the money back? Will the players get the match fee? That all depends on the contract. So what happens if the match if there is a no match? That means no loss, no profit, no need to pay anything. That is the simplest thing, but you can have your own contractual terms. Okay, so one side betting, I don't know what is that, but binomial model means you say like a lottery ticket, you lose or you win. You lose so much or you win so much. That's it. There is no other possibility. But in the example I gave you, depending on how much he scores more, that much possibilities are there. So many possibilities exist. That is why this is not just a betting and it is not a simple betting. There are more angles into it. Binomial model only in future an option? No, I don't want to comment on that point. I'm just trying to give you general point. Models, I'm not talking here. I don't want to confuse. Is this video session can be seen later? Yes, it will be available in the YouTube. You can watch it later any number of times. But you cannot ask me question there. But you can watch it. Okay. Now let me go to the one more modified version of this. So hope your facts are stored in your mind. Two persons, Sachin Tendulkar, cricket match, scoring a century. One person betting, he will. Other person betting, he will not. Now, I'm changing the betting condition slightly different. Ensure you're able to understand the factors correctly. The condition goes like this. Condition goes like this. One person says he will bet century, I am sure. Other person says he will not. You say, what's the bet? I will give you 20 rupees. Take it, yaar. If he does not score century, keep it with you. Don't give me anything. You understand? You are so confident that you paid him 20 rupees and selling, you keep it with you. Don't pay me anything. So, if he scores century, you lose whatever you paid is gone. If he does not score century, whatever you paid is gone. If he scores century, then question mark. If he scores century, this is the condition. What is the condition? Every 1 run scored above, you get 1 rupee. The 20 rupee what you paid will not come back. That is the initial betting amount. You pay him, you give it to him. Over. He received it. Matter over. But what is the benefit you get? For every 1 scored above 100, you get 1 rupees. So if he scores 101, you get 1 rupee. Whatever you pay 20 rupees gone. That will not come back. Now let us look at various scenarios what and all can happen. If Sachin scores 90 rupees, can you tell me what is his loss or profit? First person point of view. From first person point of view. 20 rupees loss. Perfect. Why 20 rupee loss? Because your bet is he will score above 100. Below 100, how much does not matter. He scores 90, he scores 95, he scores 80, he scores 75. Does not matter. What you paid 20 rupees gone. All of you are telling 20. I'm very happy. 20, 20, 20, 20. Now, that 20 rupee will be gain for another person. Other person you forget about it. If it is 100 rupees, then also he did not score above 100. So whatever you paid will not come back. So 20 rupees is gone. Or that how much excess you get. Excess amount is 100 rupees. compared with his actual score. His actual score is also 100. He did not score any excess. No excess means you don't get any benefit. Next one is interesting. If he scores 105, this you tell me. Think slowly. I will give the answer. But before that, you give me the answer. If Sachin scores 105, he has done the century or he has scored the century. So, which is what you are betting on. Will you get profit or lot? In this case, comment. I will give my answer, but try to apply your mind. Minus 20 and 5. Perfect. That is the answer. 20 rupees you already paid. That is gone. But how much excess you get? He scored 100 to 105. 5 runs he scored excess. So 5 runs you get 20 rupee. What you paid is gone. 15 rupee loss. 15 rupee loss. And the same thing will be 15 rupee gain for another person because he received 20. Now he pays 5 rupees. Net profit for him is 15. But did you observe one thing here? Even though your expectation came true, he did score century, but you lost. Operation success, patient died. He scored century, but you lost. Okay. Now, when I compare this with my previous situation, what is the previous situation? 100, everything below 100, you lost 1 rupee. 1 rupee down means 1 rupee loss. But here, your loss is limited. Your loss is limited. Okay. Now, if it goes to 120, then you will have no profit, no loss because 20 rupees you paid and 20 rupees you receive, no profit, no loss. If it is 130 rupees, in that case, how much profit you get? 30 rupees you receive being the excess and 20 rupees you already paid. Effectively, it becomes 10 rupee part. Overall, for him, it is a minus 10. So I'm getting one comment. Passed with 40 marks, but failed in aggregate. Perfect. That is what happens in this segment. This type of betting arrangement, I should not say betting arrangement, this type of contract is called as options. So what is the features of options? There will be one amount paid in advance. That is called as option premium. And you bet for a certain price. That's called as strike price. And one person who receive for the benefit is called as holder. Other person who is paying you the money, who is thinking alternatively, is called as the writer. Forget about the words. Forget about the words. Holder, writer, strike price, premium, expiry date. Don't think any of those. I'll come to it later when we discuss options. Now, what is the main difference between previous thing and this one? Previous time, every time you score he scores below 100, you have a loss. 1 rupee down, 1 rupee loss. But here, everything below 100, flat loss. Previously, downwards, linear, straight line loss. Now it is flat loss. Correct? Now, once he scores above, previously you are getting more profit. 1 run score more, 1 run more profit. 1 run score, 1 run more profit. But here, also 1 run score more profit after a particular point in time. So on the upper side, both are increasing. Both cases you will have profits. But on the downside, in one case it is flat, in the other case loss is downwards. It can go anytime below. Are you able to get the basics of the features here? I will come to individually, don't worry. I will focus on the terminologies, we'll write all the sentences, we'll look at practical examples. But I hope you get the basic idea of this arrangement. I'm getting one comment. First person limited loss, second person unlimited loss. You can say that because first person, whatever 20 rupees is maximum loss. Second person, he can have any loss. True? Very true. These are all the features of it. Okay, I'll give you 1 minute. I'll give you 60 seconds. Try to focus your thoughts. Try to arrange all your thoughts. If you have any questions relating to these two examples, you can ask me. Why? Because every time I go forward, I keep referring to this example and I'll give a technical term there. All the analysis, charts, computation of profits, everything related to these two examples I'll take. Entire chapter. This will be useful in foreign exchange chapter also. So try to focus your thoughts for 60 seconds. Okay, very good. I hope you got the basics right. So this is the introduction towards the derivative world, a world with full of fascinations, with full of amazing concepts. If you understand, this is a beautiful game altogether. I'm getting one question. Let me answer it. Strike price means for rupee 1 above 100 in this example. Is it, sir? In this case, what is the cutoff number you told? 100. Everything above 100 you get profit. That 100, that cutoff point is called a strike price. That 100 cutoff point is called a strike price. More about it we'll discuss when I go to options. But I'm just giving you an idea. Oh, this is strike price. This is option premium. This is future price. This is future contract. This is options. Okay, very good. Any other questions? Any other thoughts that you would like to share at this point in time? I hope the example is very convenient for you to follow. I'm not giving example of Reliance, Infosys, TCS. I'm not going for that directly. I'm starting from the things which are close to you, because derivative is many new concepts for many people. It's a new world. So I'm just giving you slowly these examples. Once we go into the world, we'll speak only in corporate language, means in stock market language. We'll only give the practical example of ITC, Nestle, Infosys, TCS, like that. Okay, let's go to the basics of derivatives. Now let's come back to the basic theoretical definitions of it. So what is a derivative? Now I actually told already what is future, what is options. That example I told you already. But what is future options? They are different kinds of derivatives. So we should understand academically what is a derivative. For that, take a look at this example. If your wallet contains three 500 rupee notes, now what is the value of the wallet? You say 1500, right? Because 3 into 500, that becomes 1500, because that is a value included there. And if the wallet contains 800 rupee notes, 8 into 500, you get 4000 rupees. So value of the wallet remained same, but value of the wallet changed, because that is what is called as the underlying asset. I'll give one more example. You take an example of gift coupon. You have a gift coupon, and that gift coupon says you will have 10% off on the computer you buy. If you buy the computer, 10% off. That is the gift coupon. So if the computer value is 50,000, computer value is 50,000. Now if I show this coupon, I get 10% discount. How much discount? 10% on 50,000 means 5,000 rupees. Now next day, if the computer became 60,000 rupees price, 10% off, how much discount I get? 60,000, 10% means 6,000. Now, next day, if it becomes 40,000, 10% off means discount value is 4,000. Are you understanding the basics? When the underlying asset computer price increased, the gift coupon discount also increased. 50,000 became 60,000, 5,000 became 6,000. Similarly, when the underlying asset 50,000 became 40,000 computer price, the discount price was 5,000 became 4,000. So as and when the underlying asset is moving, the derivative is also moving. So derivative always derives. Derivative is always dependent on the value of underlying assets. In the example we have discussed, Sachin Tendulkar scoring a century. That is underlying asset. The betting what you have is the derivative. So betting whether you get a profit or loss from this contract depends on what scores made by Sachin Tendulkar. So that is an underlying asset or underlying instrument. In fact, people call just underlying. And what you get as a result of that, the profit, the contract, the loss, the resultant is called as derivative. So whenever we talk about derivative chapter, you should always keep it in mind. We should compare it with underlying asset. If the underlying asset value increases, derivative value also increases. That is the interrelationship. In a sense, your life is also a derivative in different ways. Like initially when you're in childhood, if your parents moved from one city to another city, you also had to move it. You are a derivative of your parents where they were underlying asset. After some years of life where you have settled, after you move, your parents will move with you, or one more person whom you follow, that person goes to some place, you also go there. In colleges, maybe in some articleship also, I've seen this happening. One person goes, other person also follows. You understand what I'm telling? So you are a derivative of that person. That person laughs, you also laugh, whether you like it or not, but you laugh because you want to impress that person. Derivative. One more example is you and CA Institute. You have a degree called as CA, or you're going to have. I'm confident all of you will become. CA Institute is the underlying asset. CA degree, what you have, is the derivative. If the institute carries value, your degree also carries value. Because of some image, or because of some people who go against ICI, or some people within the ICI do some bad things, some corruption, something happens to ICI Institute, image will be tarnished, your CA degree also will lose its value. So this derivative is a concept, can be applied in general in many places. Uh, is the video is coming? Yeah, I'm getting something like, is the internet working? Getting some message here. Are you able to listen to my voice, my dear friends? Can you please confirm? Is my voice is audible? Are you able to watch the video? Can you please confirm? Are you able to watch the video? Is the video clear? Voice is clear? Voice audible. Very good. Thank you. I'm getting one question. What do we call the connection between the underlying asset and the derivative? That is technically in option world is called as delta. And in one second, just wait for 1 second. 1 second. I'm getting some error message in the this one. Okay. What is the connection between underlying asset and derivative? In options world, we call by one name. In future world, we call by one name. But as of now, I don't want to give any name now. It is just the connection between underlying asset and derivative. At this point in time, keep it in mind, they are connected. That much is sufficient. It's actually called as delta in options. Futures, it's called as beta, but it will not have any impact as such. So I don't want to use too much technical words, but options world, you call it as delta. When underlying asset changes, how much the premium will change. That is what is called in options. Futures, we don't have any specific word, but we have beta, but that interpretation is slightly different. Okay. Okay. Now, let's understand the basics of it. Some academics. So, derivative means three conditions to be satisfied. One, value should change with respect to underlying assets. The point that we just discussed. Second, the initial investment should be zero or minimal as compared to underlying. See, in the example of our betting example in cricket, you get 100 or you lose 100. Initially, you did not paid anything. So, initial investment was zero. Then, we discuss situation where you pay 20 rupee in advance. Then, how much or excess you get, that is your profit. So, that is where the minimal amount happens as compared to underlying asset. That's called as option premium. If strike price is 1800, your premium may be 30 rupees, 40 rupees, the advance what you pay. That is called as initial investment, either zero or it might be minimal. In some cases, this advance will come, so it should be minimal or it should be zero. And third point, it should be settled at a future date. So at the end of the match, the amount will be settled. These three conditions satisfied, it's called as derivative. And derivatives are future options. Forward contract is also derivative. I'll tell you the difference between future forward later. But future, options, forwards are all examples of derivatives. And what is underlying asset? The underlying can be share price, can be an index, can be foreign currency, can be interest rates. These are the areas in which we have to do problems. And in our example, Sachin Tendulkar scoring centuries, scoring, his batting was the underlying asset. His batting was the underlying asset. So please write down the charts. Please write down the chart. If you're This is I'm telling for my regular students. If you're just watching only for understanding concepts, take rest. Please write down this chart. And regarding the basics, the same definitions will come when we do FR, financial instruments, derivatives. Please understand this chapter carefully because you have to do accounting for this in FR chapter. So your foundation here will help you a lot in FR chapter. So when we do FR, I will try to connect these points. There I'll repeat once more. But still, if you know these concepts, foundation points very well, the derivative accounting, there's something called as hedge accounting and all becomes more comfortable when we go to Ind AS 102, Ind AS 109, financial instrument 32. No, Ind AS 102, 109. Yeah. Okay. Is there any question up to this stage? Okay, good. Very good. Let's go further. Now I'll try to talk little bit more about, okay, people are writing. After this, we will talk about little bit about the stock market terms. I'll give examples. Okay, I hope it is done. This chart. Okay, done. Let me go further. Now I will talk about certain words from the stock market, and I'll take those examples itself. You buy HDFC share at, let's say, rupees 100. After 1 month, the share price goes to 110 rupees. So you get a profit of 10 rupees. You bought at 100, you sell it at 110, you make a profit of 10 rupees. If the market comes down to 95, you will be selling at a lower price, you make a loss of 5 rupees. This is called as spot market or delivery. You pay the amount, you get the shares. Later, you sell the shares, get the money. When the market goes up, you make profit. When the market comes down, you make losses. Okay, so now because you have this uncertainty, market can go up or market can come down. You want to secure yourself. You want to make some arrangement where your profit can be fixed. This uncertainty situation can be avoided. So for that, what do? You are not selling it today. You are selling it after 1 month. You are selling it after 1 month. But after 1 month, you don't know what price it is going to happen. So today, what do? You enter into an agreement to sell at 105. These things happens in industries, in companies also. A company, let's say manufacturing company, requires raw material. They keep on buying raw material, they keep on doing processing. Now, if that prices are fluctuating, what the company will do, they will enter into an agreement with the supplier that for this year, let us fix the price. 30 rupees. Price is fixed. That's what we are doing now in this case. After 1 month, I don't know at what price I'm going to sell. So I am going to enter into an agreement at 105. Today I'm signing the agreement. After 1 month, I will sell it. At what price? I will sell it at 105. So if it is 110 rupees, at what price will you sell? Will you sell it at 110 rupees in the market? The answer is no. Because you have already entered into a commitment. You have already entered into an agreement to sell at 105. You have to honor that agreement. So you will sell at 105. You make a profit of 5 rupees. Now, if market price comes to 95, No worries. You have entered into an agreement already to sell at 105. So you make a profit of 5 rupees. So you see what is happening here. Whether market price goes up or market price comes down, your selling price is fixed. Your profit is fixed. That is called as future market. So what is a future market? A price in the future is decided today itself. You sign an agreement where price is fixed, that at this price only the transaction is going to happen. Now, in one of the betting example I gave you, that was called as, in the cricket match example, speculation, betting. Here, I am calling it as, this is actually hedging. I'll come to that. What is hedging? What do you mean by that later? But just to tell you, your profit is certain. Or you can also say, so one more thing. What is that? Don't you think I'm making loss here? What loss? See, when market price is 110, I could have sold at 110. I'm selling it only at 105. I've lost 5 rupees. Isn't that an opportunity cost for me? That is always there. But if it was 95 rupees, you would have sold at 95. That means you would have lost 5 rupees that you are saving. So there's opportunity gain also. It works both ways. It works both ways. But your profit, your realized profit is fixed. That is what is called as hedging. And futures can be used like this for hedging purpose. But don't worry too much about it. Keep the basics in mind. Future means a price is fixed in advance. Settlement will happen in future at what price? At a predetermined price. Fine. Now, if I ask you, among the two, spot market you made more profit or future market you made profit, which one would have been high? Would you select the first option or would you select the second option? In the first option, you can go up to 110 rupees. Second option, you will only go up to 105, but loss will not happen. So among spot market, future market, which one do you think is better? Or among spot market, future market, which is better? Between these two, which is better? Future market is better because your profit is certain. Okay. Some people say spot market is better because you can make more profit there. Okay, fine. As a CA student, you are in SFM class now. You are not in accounts. So you can't say whichever is higher or whichever is, you can't say whichever is lower. You can't say conservatism principle. We are in financial management. We want to optimize our profits. What we should say, if market is 110 rupees, I want spot market. If market comes to 95 rupees, I want 5 rupees. That is a future market. Correct? Again, I'm getting one answer because there is no loss in future market. In this example, no. In some other example, it might be. That is what I'm trying to tell you is, if market goes up to 110, you may want to go for 110. If market comes to 95, then you want futures. So in some cases, you want to sell in the spot market. In some cases, you want to sell in the spot market. In some cases, you want to sell in the future market. Yes, if you want to hedge yourself, you can go for future market. That I'm not denying. That's one choice. But we should not understand our discussion to one choice only. We should understand from the all possibilities perspective. Different people exist in market. Different kinds of clients come to you. You can't tell you do this only. That's what I'll tell you do, or you do, you get lost. You can't tell like that. Depending on different people's requirements, we should give the appropriate options, appropriate alternatives. Correct? So here there might be a person who says, if market goes up to 110, I want to sell in the spot market. If market comes down to 95, I want to sell in the future market. So entering into an agreement means it puts an obligation for you that you have to do it. So what we do here, we give them one more agreement. What is that one more agreement? Please read. You enter into an agreement having a right to sell at 105. Please observe the difference. Right to sell and agreement to sell. Agreement to sell means agreement to sell means you have to honor your obligations. You can't think otherwise. But in this agreement, you have the right, you have the choice, you have the discretion. So what will happen? After 1 month price, if market comes to 110 rupees, now which is better? Is it better to sell in the spot market or is it better to sell in the future market? You say 110 rupees, good price. This agreement, scratch it, scrap it. Why? Right? No, I had the choice, I had the discretion, I have the right. I can cancel it, I can continue it. It belongs to me. I can decide. I have the power. So what do I do? Cancel it. Go to market. Sell it at 110 rupees. Make a profit of 10 rupees. If it comes to 95 rupees, oh, then don't go to market. Market give me 95 rupees only. Come to this agreement. This agreement is still open. I have not cancelled it. Sell it. Besto. Sell it at 105 rupees. You make a profit of 5 rupees. So what is happening here? In both cases, you're making profits. In both cases you are making profits. If it is above, you can go up to 10 rupee profit. It comes below, minimum profit is there. So you can't have both the advantages. Therefore here, when you enter into an agreement having right to sell, you have the right. That right will not come free of cost. You have to pay amount for it. That's called as option premium, and this market is called as option market. See, no right comes free of cost. In a democracy also, you should understand, if you are getting something free, somebody else, some taxpayer is paying for it. Nothing is free in this world. If you are getting free, somebody paid for it already. Fine, you understand? Okay. So in spot market, the prices are determined at that point in time. In future market, the prices are decided in advance. It's a forward contract price. In option market, you enter into similar to future market transaction, except you don't have an obligation to sell, you have a right to sell. Depending on the market conditions on the date, you can decide whether the agreement should be settled or agreement should not be settled. So please write down this chart also, my regular students. Please write down this chart, and if you have any doubt, please ask me. I will address it. Please write down this chart, my regular students. If you have any doubt until this point, you can ask. I'm getting one question. How in both cases 110 and 95 we will be having 5 rupee profit? This is because I already bought at 100 rupees and I'm going to sell it at 105 rupees. Whether market goes to 110 or comes to 95, I have an agreement to sell at 105. So my selling price 105, purchase price 100, I make a profit of 5 rupees. I'm only talking about realized profit here. Opportunity cost I'm not discussing. Realized profit, 5 rupee profit, whether market goes up or market comes down. In the agreement to sell, price of the share does not affect your agreed price. Correct. You already agreed. So market price don't have any impact. Your commitment, you just honor it. You have entered into an agreement to sell at 105. You sell it at 105, make a profit of 5 rupees. I'm getting one question. For one transaction, 3 markets are available. You mean us to decide. There are so many markets available. I'm giving 3 markets in this illustration. Spot market, you can buy and sell. Future market also you can sell. In option market also you can sell. So you can sell in spot market, you can sell in future market, you can sell in option market. 3 different markets in this example. Many more markets exist. These are the basic examples. So at this option, spot market plus future market is spot plus future is options. I'm not really telling that directly in this example. You can tell because the prices happen to be same. But I would suggest don't do too many analysis at the beginning itself. So point here is we have 3 markets. In spot market, you may buy and sell. In future market, you may buy and sell. The price is decided today. In option market, you may buy and sell. But in option market, you have a choice. If you want, you can sell. Otherwise, you can sell in the market, spot markets. Okay. I hope you have written the charts. Regular students, please confirm. Have you completed this chart? Yes. Okay, very good. Let's go to some practical examples and try to understand the meaning of it. What does exactly it would imply? Let's go to the website and do it. Many websites are there, popularly. I will go to NSE website. I will go to NSE website and do it for you. Okay. Fine. So let us go to NSE website. I hope you're able to see the NSE website. Can you please confirm? Is the website appearing? Because I have to do some settings and all here. Is the website appearing? Are you able to see the website? NSE.com, NSEindia.com. Yes. Okay. So let me go to the website and let me look for Infosys. Infosys share price. Okay, Infosys share price. How much is Infosys share price? Can you see the number and comment? What is the Infosys share price? You see that number? How much is the amount? Are you able to see it? What is the share price amount? You see that 833.95, 833.9. And how much is stock up by? Stock is up by 6.47%. So much up. In nowadays, you understand, in fixed deposit also you don't get 6.7% in one full year. One day 6% is up. One day 6% is up. You know why? In expectation of the Infosys quarterly results. They have announced, I think, once we started our our classes, I think they would have announced. It is yet to come. But expectation is it is going to give more profits. So those things we have analyzed in our share valuation chapter. We discussed when a company makes more profit, the P&L account show more profit, the P ratio will be affected, or applying the P ratio, expected EPS will increase. So all those things, FCFF implication, we have discussed. So our objective is not that here. Our objective is here is what is this 833.95? Let's say 834 rupees. This 834 rupees implies if you want to buy the shares today, you make a payment of 834 rupees. Or if you are a person trying to sell it today, your selling price is 834 rupees. Meaning spot price of Infosys on this date is 15th July 2020 is 834 rupees. So we'll write on all those things. So spot market on Infosys share price is today 834 rupees. Simple, straightforward, nice. Now come to this one. Here you see derivatives, derivatives and stock futures. Stock futures. How much is the close price? I think close price is not traded. Let's take last trade price. Last traded price is 837. Last trade price is 837 and expiry date is 30th of July. Are you able to see that number 837? I think you are not able to see. Yeah. Now are you able to see 837? This number 837 last towards the end here. I think this number 837. Right? This number 837. Yes. Now, what was that 834 rupees? 833.95. If you want to buy it today, that was 833 rupees. If you want to buy it after 1 month, what is the expiry date? Expiry date is 30th of July 2020. So if you want to buy on 30th of July 2020, it is 837 rupees. So today if you want to buy 833.95. If you want to buy it on 30th of July, irrespective of market price, you will be paying 837 rupees. Not today, you will not pay 837 rupees today. You will pay 830 rupees, 837 rupees on 30th of July. But today you are entering into a commitment. You are entering into a commitment. Now, look at the options. Look at the options. What does will tell you? Strike price 900. Last price 8.5. Are you able to see this again? 8.5. Please check it. Are you able to see this 8.5 number? It is 8.5. Is it visible? Yes. So what does 8.5 means? If you want to buy at 900 rupees after 1 month, means on 30th of July, today you have to pay how much? 8 rupees. How much that 8 rupee looks like? That 8 rupee, remember the betting game example versus in the cricket match example, you have to pay 20 rupees. For every 1 rupee score more, you get extra profit. But some amount to be paid in advance. And if things does not happen, that amount is gone. That is this 8 rupees option premium. Let's do one thing. Let us write down in the form of sentence. So you get the more accuracy with respect to our calculations. Then we can go for the problems. Okay. Let's write down. So this is as on we are doing it on 15th of July 2020. So I'm taking the underlying assets. I'm taking the assets, the Infosys share price of Infosys. So I told you three markets. One is spot market, then future market, then option markets. Now, in the spot market, the price was 833.95. That was the price. In the future market, it was 837 with expiry date 30th July. And options market, the price was rupees 8 rupees. Again, expiry date 30th July 2020. Now, what is the interpretation of this? Implies if share is purchased today, then you have to pay rupees 833.95 today. So today, spot market, you pay 833.95, you get the one Infosys shares. Not today, you have to wait for 2 days. You know T+2 settlement we discussed, rolling settlement in India, you receive after 2 days. Anyway, but this is delivery basis. The shares will come to your demat account. Now, future market 837 means what? If you want to purchase the share on 30th July 2020, the price fixed today, not paid today. Remember, price fixed today is rupees 837. So you are not paying today. You will pay after 1 month, after the 30th July only, on 30th of July. You will get the shares after that. But you will be agreeing it today. What is the agreed price? 837. Future means agreed price. Now, what is the option market rupee 8? If you want to have a choice, have a right to buy at 900 on 30th of July 2020. Today, pay rupees 8. You are paying for the right. That is what is option premium. If you want to have a right to buy at 900, then today you have to pay 8 rupees. Did you understand what is the spot market price, what is the future price, and what is the option premium? This 900 is called as the strike price. That is the agreed price. And write down these sentences and let me know if any points needs to be confirmed. Take 2 minutes, go through the detailed calculation, the previous charts, the betting example I gave you, the derivative chart you have written. Look at all those things and tell me whether you are in line with me so far. Are you on the same page? Any questions, any points that I need to repeat? I'm getting one question. How many hours it will take to complete this chapter? My regular classes, today is the first class on the derivatives. So I'm going planning about at least 35 to 40, 35 hours, I will say. Around 35 hours I'll be using this. So I'm getting one question. Let me answer that. Can we buy the share before the expiry date or to be bought on expiry date? For that, we have types of options. I will discuss it later. But to answer your query, there is called as American option and European option. American option means it can be any time before expiry you can buy. European means only on the expiry date you have to buy. And in India, we follow European option. So the what I showed you in the website is a European option, means you can buy only on uh, expiry date. You can't buy below that, before that. I'm getting one question. In options, if you buy at 900, is a loss to purchaser. How do you know is it a loss to purchaser? 900 rupee you pay, you agree for 900 rupee for the 30th of July. On 30th of July, if market price comes to 910 rupees, if market price comes to 910 rupees, you buy at 900, you can sell at 910, you make a profit of 10 rupee, you paid 8 rupee, still profit of 2 rupee will come. If it happens 910, if it happens to be 850 or it remains at 840, loss. Yeah, that is wow. That is like a lottery you do. What is lottery? You take one lottery ticket. If the lottery wins, you win huge. Otherwise, gone. Option premium is also like that. But good, you're analyzing. I'm happy for that. You're analyzing. So only if the stock price beyond goes certain number, option buyer makes profits. But otherwise, he makes loss. His premium is gone. But his premium is only his loss. He cannot lose more than that. Any questions so far in this point? In case advance payment, how to treat? I'm sorry, I'm not getting the question. What is the advance payment? This premium is the amount paid so that it gives you the right. If you want to buy at 900, pay 8 rupees. Does not mean you should buy. If you want, you buy. If you don't want to buy, don't buy. But if you want to have the option open, if you want to have this alternative open, make a payment of 8 rupees today itself. So you can say like this. If I purchase on 30th of July, my effective purchase price becomes 908 rupees. Because 8 rupees I paid already and 900 I'm going to pay. So effectively my cost of purchase becomes 908 rupees. I'm getting one question. Understanding how to decide which mark to select. That depends on where you are more comfortable with. In spot market, you have to take the delivery, you require more money. In future market, there are certain conditions like margin money is required. In option market, the risk is more. So these things depends on your risk appetite. Some people also do intraday trading. That's all left to your risk level and how much capital you have and how much capital you are ready to lose. That is also important. It's like asking, how do you decide whether to play test cricket, whether to play T20, or whether to play 50-50 one day match? How do you decide? You can't decide. Let the player decide. If a player is good, he can play in all the formats. Virat Kohli. If some player is fit for certain things, Cheteshwar Pujara, he plays only test match. That's all their risk level, their suitability. So once you understand spot market, future market, option market in detail, then you take a call. Do you want to do in all the three or do you want to do it only few of them? But without understanding, please don't go for any direct transaction. I'm getting one question. We will pay rupees 8 today on 30th of July. If the price is more than 900, then we prefer to buy at 900. Of course, yes. That is why I'm paying 8 rupees. I want to have my right open. If it is 910 rupees, I will buy at 900. I'm getting a cheaper amount of 10 rupee. 10 rupee cheaper I get. 8 rupee I paid. It's okay. 10 rupee benefit I get. My net benefit is 2 rupees still there. But if market price is 890 rupees, that 8 rupee what you paid will not come back. That 8 rupee is gone. So if market price goes above 900, you make this choice of buying it. But if it is below 900, you don't make your choice. 8 rupee what you paid is gone. I'm getting one more question. To enter into option requires more investment initially as compared to other markets. I'm not completed the discussion, so you cannot say that. And one more point, if I compare spot market, how much you have to pay? Today you have to pay 833 rupees. In option market, how much you have to pay? You have to pay only 8 rupees. So you can't say that option requires more investment. Spot market requires more investment in the sense. 833 rupees required. Option market only 8 rupees today. No, today I'm talking about. So there are many angles to be considered while making a decision where amount is high and what kind of risk return, risk to volatility, all those things how do you get. So don't make the judgment now itself. Just make sure you have three options open, three alternative exist up to this point in time. Any more questions? Today's session is only about discussion. I doubt if I am able to solve maybe one or two problems maximum, not at all on option futures, just to make your foundation strong. I want people to ask questions and make your foundation strong. with respect to basics. Because what I've seen people is this: they, first of all, many people or most people, I would say, you don't have practical insight. It's not your mistake. CEO office don't do trading. You have practical experience in income tax. You know to file GST returns. You know how to do costing or financial management, or you do all these company registrations and all you do. SFM, that is stock market knowledge, you may not have. That's why I'm spending time so that you get the basic things right. Then we go into the technicalities in detail, various scenarios, strategies, computations, ratios, hedging, beta, delta, whatever it is. We'll do all those things. But make yourself comfortable with the terminologies. What is spot market? What is future price? What is expiry date? What is option premium? What is strike price in option premium? What will happen if the market price goes above? I will not exercise. I mean, my premium paid is gone. So all those basic things, try to get it. Uh, One question I'm getting, you said T plus 2 spot market. What does it mean? That is called as method of settlement. That is rolling settlement transaction plus 2 days. If you pay it today, should get the shares. You don't get the shares today itself. You get the shares after 2 working days. That's called as rolling settlement. That is what is Indian method of settlement is. For more details, that is other part. I should not discuss much here. There is just the time gap between the date of payment of cash and the date of receipt of shares. Time gap. That is called as T plus 2, transaction plus 2 days. Okay. I hope no other questions. Okay. Just to reiterate what we understood so far, uh, I'll give an example. Please don't take me personally. It's only for example purpose. It's only for example purpose. Don't take me personally. Spot market is like Swayamvar. You know what is Swayamvar? How the marriage happens? On the date of marriage, one person comes. Now, whether that person is what you like or you don't like, you can't have a choice. Whatever comes on that day, you have to accept. Spot market, you may get a profit, person you like may come. You may get a loss, person who you don't like may come. You have to accept both ways. Future market means what? One more chance is there. What if nobody comes? So what do? You have a question mark. We don't know what kind of people comes on the date of marriage. You don't want to leave that choice open, risky. What do? Today, you enter into an agreement. That is called as engagement. What is the advantage of engagement? On the date of marriage, you know one person will come for sure. So your profit is fixed. Some other persons may walk here and there. They are all opportunity cost or opportunity gains. Some beautiful person may walking here and there. You can't do anything. You are already committed. You are sold out. Some bad looking people, people you don't like walking here and there, feel good. You enter into an agreement. So you are safe. Opportunity gain. So it can work both ways. But your profit is fixed. You are sold out. Literally in some cases. The agreement to sell at a certain price. You know, you will have price also sometimes. I cannot use that word. In marriage, some price also fixed, where some product is sold and some money is also paid. You understand? And that money is decided in advance. Agreement to sell, engagement, decided in advance. And one more example, if I have to give, campus placement. So, what is campus placement? When you are in the last year of studies, you get hired. Your salary also fixed. Your pay pack is fixed. Package is fixed, but you don't get that money. You get money only once you start earning later, but the money is fixed in advance. That is also future market, forward market. Again, one more example, don't take me bad. One person who was in college was in love with the girl in the college only, and they got married. And their parents asked, "What is this? Without informing us, you got married." They told, "Campus placement." So different kinds of campus placement, different kinds of application will happen. Anyway, so come to the last point. So you have swiver where things are uncertain, then you have engagement, future market, forward market. Now you want to have an option of both. You are entering into one relationship, you are in one commitment, but you want to have your choice open. Then what alternative? I know in option market shares are there. What alternative? You say living in relationship. If things goes well, you go with the person, otherwise you go with another person. No commitment as such, no legal boundings. You always have a choice, you always have a right, you always have a discretion. It comes with a price. Every right also comes with a price. Anyway, I just want to give an example, don't take me personally, so that you remember the examples, not only examples, the concepts also. Anyway, only for that point I wanted to discuss this once more. So examples we have discussed. So now we have to understand the three terms about speculation, about hedging, and about arbitrage. So three terms you have to understand, because I told you derivatives can be used for betting purpose. That's the example I started with. That is speculation. It can also be used for hedging purpose. It can also be used for arbitrage purpose. So those things we will take it up after a break. So take a break of 10 minutes. We'll meet after 10 minutes. And now we will focus on these three terms. Today target is only these three. What is speculation? What is hedging? What is arbitrage? And some basic terms, long, short, that those kind of things, shorting concept, stock lending mechanism, short sell, those kind of things we are going to discuss today. So take a break of 10 minutes. We'll meet after 10 minutes and we will discuss about three terms and basics of short selling also we'll discuss today. Okay, 10 minutes break. Okay. Hope people are back. Let's understand the basic terminology: speculation, hedging, arbitrage. Now, derivative can be used for these three purposes. So, when we solve problems on futures, when we solve problems on options, we have to solve problems on these things. Okay. So, we'll understand now what is speculation, what is hedging, and what is arbitrage. Speculation means uncertain profit, risk element. Betting is speculation. Buying the shares, expecting that it will go up, is speculation. Whenever things are uncertain, my dear friends, you writing a CA exam, is it speculation? Some people say, may, no, no, speculation. No, it is also speculation. In the sense, do you know what question paper is going to you get? No, you don't know, right? If you know, let me know, please. I will help my students also if you know the question paper. Obviously, you will not know. So things are uncertain. That uncertain situation is called as speculation. So when things goes well, you make profit. When things don't go well, you make loss. So this derivative can be used for speculative purpose. So you take a bet, market price will go up. If it goes up, you make a profit. If it comes down, you make loss. That is called as speculation. Now, that is first point, uncertain profit. Next, we have second, hedging. Continuing the same examples of the examination, you are a CS student, you don't know the question paper, it is speculative, it is uncertain, it is risk. So, what do you do? To reduce the risk, what do? You prepare well. You come to classes, you take coaching class, you take video class, you take exams. They are all hedging techniques. What is the meaning of hedging technique? It's a risk management technique. It is a process of minimizing the risk. It's a process of sometimes avoiding the risk. Simple example. We are in rainy season. It may rain, it may not rain. You take risk. I will not take anything. I will just go out. Today I know it will not rain. It will not rain? Yes, things will fine. It rained, it goes against your expectations, then you have to suffer the loss. To avoid it, what do? You take one umbrella. You cover yourself. You take a shelter. That is called as hedging. So hedging means there has to be a risk. Rain is a risk. And how do you minimize the risk? You can't avoid the risk. How do you face the risk? You face the risk by taking an umbrella. You take a shelter. The hedging means there has to be a risk. So speculation means risk. Hedging means there is a risk, but risk you want to minimize, risk you want to reduce, you use tool. That is hedging. One more example. Your health is a risk. Your health may get bad anytime because of this pollution. These days, the health facility, the health of normal human being is coming down for various reasons. So when you feel sick, you may have to admit it hospital. Big payment will come. How do you face it? You take medical insurance premium. Medical insurance, you have to pay premium. So if things goes bad, okay, there is medical insurance, there is a coverage. If this don't go well, water premium, will it come back? No, premium paid is gone. That is hedging. Hedging will have a cost, but it will ensure your risk is minimized, your profit is minimized. Many people do BCom along with CA. Why? Because you do CA. If it happens, well, good. If not, what happens? If CA does not happen, you need a backup. People do BCom for hedging purpose, for securing themselves. And I have to give an example. You know, Rakesh Junjunwala, we would say Warren Buffett of India, or at least the most looked up person too in India. In stock market, successful person is the big bull, Rakesh Junjunwala. He is a chartered accountant. We should be proud. So if you want to have a career, follow his footsteps. Try to read about him. Try to get inspired by him. You know, You people do BCom along with CA to do hedging. You know what Rakesh Jhunjhunwala did? He did CA as a backup. You do BCom for CA risk. For him, CA itself was a backup. How? He was always interested in stock market from its early age. He's telling in its lot of stories. You can watch his videos online. YouTube, you search, you get lots of videos. He says, I want to go into stock market. He was always into stock market. That's what encouraged him. That was inspired him. That's what created interest in him. Numbers, stock market. So his father suggested you go for stock market, but please do BCom CA and then go to stock market. So if things don't go well in stock market, CA is there. You can always go into practice. In his so many videos, Rakesh Jhunjhunwala has told this. Because I have a CA degree in hand, I could take any risk in stock market. Even if it fails in stock market, I know CA where I can always fall back upon. I have always CA which gives me food. I can always do practice. I can do some work. CA I know gives me job. That's the power of two-letter word CA. Rakesh Jhunjhunwala did chartered accountancy as a backup to support his career in stock market. Power of CA is not less. Don't underestimate it. Don't take it lightly. Don't read for the heck of examination. This CA two letter is your life. These two letters comes within your name, will come with you. It will give you food till you die. So it is providing you so much. You should give your time. You should give your energy. You should give your resources. Only when you give, you can get. Right? Only those who are ready to give, you will get it. Anyway, so come back to hedging. So simple. What is the meaning of hedging? Hedging means, again, I give an example. Don't take me wrongly. Hedging means having a backup before breakup. Having a backup before breakup. Before something happens or before having a breakup, have one backup. So you're always protected. Anyway, that is called as hedging techniques. How you can use futures, how you can use options for the hedging purpose, we will discuss in the due course of time. Fine? Good. That is first hedging technique. The speculation is done. Arbitrage. Now, arbitrage means, in simple words, mispricing. That is, future supposed to be this much price. Option premium supposed to be this much, but it is not the case. There is an opportunity. You can make quick profit. So arbitrage means riskless profit. It's also called as riskless profit, or some people call certain profit, guaranteed profit. Why will you get guaranteed profit? Because market price is not properly priced. Simple example. Simple example. Let's say in one market, some fruits are selling at 30 per kg, rupees 30 per kg. Some fruits. In next market, immediately next to that, it is selling at rupees 39 per kg. Same quality, no different quality. What will happen? The price is not same in the two markets. What will happen? A person who is intelligent will come here, will see, oh, 30 rupees here, 39 rupees here. I have a good opportunity. What? I will buy at 30 rupees and I will sell it 39. I make a easy profit of 9 rupees. Why that 9 rupee profit? Because there was an opportunity and you made use of it. This imperfect market price between two markets. So if you want to have arbitrage, you should have two markets. It may be spot market, it may be future market, option market. Within the spot market, you can't do arbitrage. Within the future market, you can't do arbitrage. Between spot and future market, you can do arbitrage. So when I compare spot and future, I can buy in one market, I can sell in another market and make a riskless, guaranteed, certain arbitrage profit. Now, when this arbitrage profit will happen? When you have two markets, same time, products are same, quality is same, but the prices are different. So you buy in one, you sell in another, you make a profit. For example, BSE, Bombay Stock Exchange, is a market. NSE, National Stock Exchange, is a market. So you buy in one, sell in another, you can make a profit. So if I have Infosys share price in BSE, NSE at the same point in time, it cannot be too much different. See, we told you it is around 834 rupees, 837 rupees. Here in BSE, it will be around 830 rupees only. If it is 900 rupees, what do you do? It's quick, you buy here, you sell here. You make a profit. That is a certain profit. So why the arbitrage exists? Arbitrage exists because of imperfect market price. Arbitrage exists because of imperfect market price. And what is arbitrage transaction? You buy in one market where price is cheap, you sell in another market where price is high, guaranteed profit, there is no risk, certain profit. But as and when recently in the market technology has coming in, computer is coming in, this arbitrage opportunity is not really available, because if any available, computer softwares will throw it up, so people quickly will make use of it. That is one reason. Another reason for you to understand this aspect is, observe, in one market it is 30 rupees, another market 39 rupees. So 30 rupees, people like to buy more and more at 30 rupees. So what will happen? There is, at 30 rupees, there is demand increase. 39 rupees, people want to sell it up. So 39 rupees, supply increase. So when there is a demand supply, over a period of time, there is a equilibrium maintained. So 30 rupees price keeps increasing because more and more demand. 39 rupees price keeps falling because less demand but more supply, and over a period of time the balance will be maintained. So arbitrage is a short term opportunity. You have to keep looking at the price. The moment it is available, go and execute your trade. If you miss it, opportunity gone. So arbitrage is a momentary benefit, short term benefit, momentary. Opportunity is there, make use of it. Because the prices in two markets are not fair, they are not properly priced. These are the three objectives of uh, the usage of derivatives. Please write down these three objectives, simple ones only. Speculation means risk, hedging means risk management technique, minimizing the risk, and arbitrage means taking advantage of imperfect market price, that is buy at cheaper price, sell at higher price. Please write down this and let me know if you have any doubt. Are you clear about three aspects? What is speculation? What is hedging? What is arbitrage? So for hedging, there is one risk and there is one tool which can manage the risk. For arbitrage, there is two markets where you can buy in one market, sell in another market. So speculation means risk. So hedging means one creates risk, and there is one tool like derivatives manages risk, minimizes risk. Arbitrage means there are two markets. One market, you have price is high, and another market, price is less. Yeah, chart is given material, it's fine. But as long as you understand, this is sufficient. Any question on these three terminologies? Speculation, hedging, arbitrage. So we have to understand how derivatives can be used for speculating, means betting, how derivatives can be used for hedging, and how derivatives can be used for arbitrage purpose. Not arbitrage purpose, arbitrage in derivatives. In using derivative transactions, arbitrage profit opportunity can be achieved. Are you clear? Any questions so far? Please confirm if it is done. Okay, good. Okay. Some more basics we have to understand. First assumption is there is always zero position, means there is opportunity cost. Settlement types, delivery basis, net basis. Then position we have to understand long position and short position, short sell. We have seen this word short sell in portfolio management. APT model, we have done this problem. Now we need to understand more about short position, short sell. We'll spend the time. The first thing we will focus on basic assumption, zero position or opportunity cost. This I told you. We always assume you start from zero position. When you invest in the market, you might borrow money and then you invest, or you might borrow, or you have your own money and you invest. Whether you borrow money, you invest means you have to pay interest. If you use your own money and you invest, you have expectation from using your money in terms of opportunity cost. That becomes your cost. That is, in financial management, IPCC, corporate finance, we have learned financing decisions. If it is outsiders funds, it's called as cost of debt, rate of interest you pay. If it is own funds, equity shareholders funds, cost of equity, opportunity cost. How do you calculate? CAPM model, portfolio management, CAPM model will tell you if you're taking so much of risk, you should get so much of return. That is what is zero position. So zero position means there will be cost. You can write the heading zero position means there will be cost whether the source is own funds or outsiders funds. There will be cost whether the source is own funds or outsiders funds. Now, outsiders funds means you will have interest, and own funds means you will have expected return, nothing but opportunity cost. Expected return, nothing but opportunity cost. So that is zero position. So whether you use own money or you use outsider money, both will incur a cost. Own money will have opportunity cost. Outsiders funds means you will have interest. Borrowing money, loan, debt. Hope you have taken down. Okay. Basic assumption is done. Now it comes to settlement types, delivery basis. Delivery basis means actual transfer, and net basis means only difference in cash. Difference in cash. How it works? Let me give an example. Example. Suppose you are having like this. You entered into purchase entered into a contract you entered into a contract, an agreement to purchase some product at rupees 100 per kg, 100 per kg on, let's say, 31st of December 2020. Some date you're going to purchase. Now, on 31st of December 2020, market price of the product happens to be, let's say, 110 rupees. 110 rupees. So you have two choices. Settlement by delivery means what? You buy at rupees 100. Why do you buy at rupees 100? Because you have already entered into an agreement to buy at 100 rupees. So you pay 100 rupees, get the product and sell in the market at rupees 110, because in the market price 110. So you make a profit of rupees 10. You make a profit of rupees 10. Or if it is settlement by net basis, what happens? Settlement by net basis. What the other fellow will tell you? You pay me 100 rupees. I will give you 1 kg. You go to market, sell it at 110. How much profit you get? You get profit of 10 rupees. Let's do a deal. What is that? Don't buy from me. Don't go to market and sell it. Don't go to market and sell it. What is your objective? You want a profit of 10 rupees. I will give you 10 rupees. Your profit is achieved. Things are simple now. Just 1 second. uh, Just give me 1 second. I think the internet is buffering, I think. Okay. Is it fine now? Can you please confirm? Is it fine now? Please confirm. Is the internet back? Is it working? Are you able to hear my voice? Are you able to see the PPT? Yes. Very good. So I'll explain once more. So settlement by delivery basis means you pay 100 rupees, buy the product and go to the market, sell it at 110 rupees, make a profit of 10 rupees. Simple. Now, settlement by net basis means what will the other person will tell? Why do you go to the market, sell it? Then, you take it from me, then go to the market, then sell it. After doing all these circles, what do you get? You get rupees 100, rupees 10. Instead of doing this all this process, let us do one deal. Don't buy from me. Don't go to market. You want profit of 10 rupees. I will pay you profit of 10 rupees. So what is really happening? Contracts cancelled. Contract cancelled. And uh, you will receive rupees 10 rupees. Overall, what is your profit? Overall, your profit is 10 rupees only. So ultimate profit remains same. So you may ask, what will happen if it is market price is not 110 rupees? If market price is, let's say, not 110, if it is 90 rupees, no problem. What would have happened? You would have bought at 100 rupees. That is anyway agreed price. You go to market and you make a profit, sell it at 90. You would have made a loss of 10 rupees. You made a loss of 10 rupees. Now what do you do? Do the same thing. Don't buy at 100. Don't go to market at 90. What is the loss you are facing? 10 rupee loss. That only you pay. 10 rupee you pay and total loss becomes 10 rupee. Right? 10 rupee. Your loss will become 10 rupees. So whether market price increase or market price decrease, it may be settled on net base. You can do settlement on delivery basis where contract is executed, or settlement on net basis. This is also called as settlement on cash basis. Why settlement on cash basis? Because you either you receive cash or you pay cash. If things are in favor, you receive cash. If things are against, you pay cash. As simple as this. If it is in favorable position, you receive money. If it is favorable position for another person, you pay money. This problem of settlement by delivery basis is avoided. Now, you can't say that, oh, settlement net base is so simple. Why delivery base required? That is left to the person, let them decide. You don't give them suggestions. See, if you are a sugar manufacturing company, you need sugar cane. You can't do net basis settlement. You need sugar cane to produce sugar. So settlement has to be on delivery basis only. Correct? So the method of settlement, let the party decide. You don't give suggestion, but you understand settlement may be happen by delivery basis where contract is executed and profit is achieved, or settlement may happen by net basis where contract is cancelled and difference of the agreed price and the market price is either paid or received, and net amount profit is received in cash basis. So it's called as settlement by net basis. But remember, both settlement ultimate impact is same. Whether settlement is by net basis or settlement is by delivery basis, ultimate profit is 10. Ultimate loss is 10, depending on the market price is high or less. So method of settlement don't change the ultimate outcome, but it does change the individual transactions. Hope you got the point. Let me know if you have any doubt. After this, we'll write one sentence. That is, we'll write few sentences on the settlement mechanism. Settlement mechanism. Please let me know if you have any doubts, any questions on this aspect. Clear. Good. Give the heading settlement mechanism. Settlement mechanism. Below that, write down an agreement entered. An agreement entered. An agreement entered for a settlement at a later date. An agreement entered. An agreement entered on settlement at a later date. On settlement at a later date may be settled by delivery basis, may be settled by delivery basis, may be settled by delivery basis, or settled by net basis, or settled by net basis, or settled by net basis. Settled by net basis. Within brackets, cash basis. Net basis is also called as cash basis. Net basis within brackets, cash basis. Cash basis. And next sentence, continuous sentence, next sentence, same paragraph. Same paragraph. Both settlements results in same impact on overall basis. Results in same impact on overall basis. Same impact on overall basis. Okay, then you write down settlement by delivery basis. Settlement by delivery basis. Settlement by delivery basis. Below that, first point, under this method, contract is executed at the agreed price. Contract is executed at the agreed price. At the agreed price. At the agreed price on the date of settlement. At the agreed price on the date of settlement. On the date of settlement. Second point. Units purchased. Units purchased as per the agreement. Units purchased as per the agreement. Units purchased as per the agreement is sold in the market. Is sold in the market at the price sold in the market at the price prevailing in the market. At the price prevailing in the market on the date of settlement. At the price prevailing in the market, prevailing the market on the date of settlement. On the date of settlement. Third point. Third point. The difference between the above two transactions, difference between the above two transactions, difference between the above two transactions, difference between the above two transaction is the profit or loss for the buyer. The difference between the above two transaction is the profit or loss for the buyer. For the buyer. Okay, so this what you have written is on the heading settlement on delivery basis. Next heading, settlement by net basis. Settlement by net basis. Settlement by net basis. Okay, write down under the first point. First point, contract is cancelled. Contract is cancelled. Contract is cancelled. Second point. Second point, difference between difference between difference between price as per the agreement, difference between price as per the agreement, difference between price as per the agreement and price as per market, price as per market, price as per market, price as per market prevailing on the date of settlement, price as per market prevailing on date of settlement is paid or received, is paid or received, paid or received in cash, paid or received in cash depending on depending on depending on depending on whether it is favorable, depending on whether it is favorable, depending on whether it is favorable or unfavorable situation, depending on whether it is favorable or unfavorable situation, favorable or unfavorable situation. You understand what is favorable, unfavorable. Favorable means you receive profit, unfavorable means you pay profit. Okay, next, third point. Third point, the net amount received or paid, net amount received or paid, net amount received or paid, net amount received or paid is the profit or loss for the buyer. Net amount received or paid is the profit or loss, is the profit or loss for the buyer. Profit or loss for the buyer. Profit or loss for the buyer. Then you write down this example. This example what you written, you can write down. And if you have any question up to this point, you can ask. Write down this example, and once it is done, let me know. So we can go to next concept. Is it done? Is it over? Is it completed? Shall we go further? Okay, good. Okay. So next one is the most important, I would say, long position and short position. Long and shorts. Positions. Long position and short position. Very, very important terms. Many people have confusions about these terms application. People do lot of mistakes in this case. We have to understand how these things works theoretically, and also we'll look at how things works practically. Okay, now long position means very, very simple concepts. Let's say you buy some products at 80 rupees. You buy some product at 80 rupees. If it becomes 85 rupees, you make a profit of 5 rupees. If it becomes 75 rupees, you make a loss of 5 rupees. Simple example. So long position means you buy and then sell. And if market price goes up, you sell at a higher price. And if market price comes down, you sell at a lower price. So when you sell at a higher price, you make profit. When you sell at a lower price, you make loss. Very simple concept. Market price goes up, you make profit. Market price comes down, you make loss. Very simple concepts. So write down in long position means simple thing. You buy first and you sell later. You buy first and then you sell later. And if market price goes up, market price up means you make profit. If market price comes down, you make loss. Very simple concepts. You buy first, sell later. If market price goes up, you make profit. If market price comes down, you make loss. That's normal understanding. Normal position, long position. Short position is very, very interesting. You sell first and you buy later. You sell first, you buy later. Now, how this happens practically, put it on hold for a second. I'll come to that in some time. You can always ask, when I don't have, how can I sell? When I don't have, how can I sell? We'll come to that point later. First, imagine I'm giving you magical power. I'm giving you God power. You sell first, then buy it. Not buying and selling. You sell first and then you buy it. Example, let us see. You sell at rupees 100 and market price becomes, let's say, 110. So you buy at 110. Can you tell me, will you make profit or loss now? You sold at 100, you buy it at 110, that is market price is increasing. You have to buy at 110. Can you tell me, will you make profit or will you make loss? Will you make profit or will you make loss? You buy it, you sell it at, you already sold at 100. Now market price 110. Now you have to buy at a higher price. If you buy at a higher price, is it loss or profit? Loss, because you buy at a higher price. If it comes down, if market price comes to, let's say, 98 rupees, market price is down. Now tell me, will you get a profit or loss? Market price is down. Market price is down. So will you have profit or loss? Try to think and comment. You sold at 100. Now market price has become 98. So at 98, you have to buy. At 98, you have to buy. So can you tell me, is it profit or loss? Try to comment. I'm getting some comment. Loss, profit, loss. It's going to be profit. You sold at 100, purchased at 98. Your purchase price is less, selling price is high. Profit. You make a profit of 2 rupees. The reason why I'm spending so much of time, I'm going slowly on this aspect, is because many people have the mindset market is down means loss. Market is down means loss. Not necessary. If you have taken a short position, means you have already sold. Now you're looking for buy price. Now buy price means you will buy at a lower price. If the price is down, you end up buying at a lower price, means profit. So what is the interpretation? If market price is up, you will have loss. If market price is down, then you will have profit. You can write down the simple chart and you can write down this example if you want. So when the market price is up, you had a loss. When the market price is down, you have a profit. You can write down this chart, simple chart. So you can also say like this. Long position means it's a bet on market price going up. Don't write bet and all in examination. Think like that. Long position means it's like a betting that market price will go up. And short position means it's a bet on market price going down. So long position, purchase price fixed. Selling price is uncertain. Whereas in short position, selling price is fixed, purchase price is uncertain. So long position means it's a bet on price going up. A short position means it's a bet that price coming down. So you can make profit in both situations. Market price up also, loss also. I mean, market price up also, down also. But when you should have taken appropriate position. If market price going up, you should have taken a long position. If market price coming down, you should have taken a short position. If reverse happens, you have to incur loss. So if I am a person who thinks market price goes up, I should take long position. If things goes up, I get profit. But if things goes down, I make loss. Right? Now, if I'm thinking market price goes down, I should take short position. If things does go down, my expectation becomes true. I make profit when the market is falling. If the market price goes up against my expectation, I will make loss. So when the market is going up, you can make profit. Market is coming down, you can make profit, but your position should be appropriate. There is one movie called as The Big Short, SHORT, The Big Short, which talks about 2008 Lehman Brothers, the banking sector collapse in the year 2008. It was captured beautifully in that movie. You can watch if you have time. Instead of watching some other kind of movies, you can watch this movie, The Big Short. It talks about the 2008 crisis and it talks about the short concept. Beautifully, they have explained. It's an entertaining movie and a conceptual movie. If you have time, you can go through it. The Big Short. How a person can make profit when the market is falling down. Okay. Any question on this aspect? Basic terms, long position, short position. We will also go to the practical application of short position in few seconds from now. But before that, do you have any question on the basic terminology of what do you mean by going long and what do you mean by going short? Going long means I'm taking a bet that market price will go up. Going short means I'm taking a bet market price will come down. Let's write down that also. Going long means taking a bet, or let's say expecting market price would go up. And going short means expecting market price would go down. Going long means going up and going short means going down. Okay. How can we sell without the shares? I'll come to that aspect. How it can be done practically? I'll tell you that aspect. Practically, I'll tell you. But conceptually, are you able to get overall, theoretically? If I tell you going short, go short means you're expecting market price to come down. If you're expecting market price to increase, you say go long. Terminologies, are you able to get it? Are you comfortable? Terminologies and its interpretations. Yes, good. Now, before I go into more details on short position, I will go more into my long position first. I would like to spend little bit more time on long position first. I hope this is done. Let me spend some time on long position. Long position transactions. Long position transactions. Okay. So what transactions you do today? Now, first of all, here we said you buy first, sell later. So in share market or in spot market, we are telling today you buy the share, and later you sell the share. Difference is your profits. Later you sell the share. If market price goes up, you make profit. If market price comes down, you make loss. That's what we discussed, right? Spot market, today you buy the share, later you sell the share. If market price goes up, you make profit. If market price comes down, you make loss. Now, one question here, you are buying the shares. How will you buy the shares? You say, go to market, buy the shares. Who will give you the share? Free shares. You have to pay money. Where will you get the money? I have my money, my savings are there. What we just discussed, zero position. What is the meaning of zero position? Zero position means whether your own money or outsiders' money has a cost. So before you make a decision to buy the shares, first you should look at its source, zero position. That I'll call it as money market. And I would say you have to borrow money. You have to borrow money. You understanding this? Before you buy the share, first of all, you should have money. When you don't have money, you borrow money. If you have money, use money. But both will have a cost ultimately, either interest cost or opportunity cost. So your first step is borrow money, then you buy the share, you go to the market later, you sell the share, that money you receive, that later you repay money. You repay money. For example, let's say you borrow rupees 100, you buy the share, one share you buy, then you buy it at 100, you sell at, let's say, later at rupees 120, and you repay 100 rupee. You have to pay interest, let's say 8% interest means 8 rupees, 108 you have to repay. So 120 rupees you receive, 108 you pay, net profit is 12 rupees. Hope you understand that point, but get the overall point. So on money market, you have to pay interest. So whether market price goes down or market price comes down, goes up or comes down, you have to pay interest expense. You have to pay interest expense. So only net profit overall means you should consider the profit or loss and then interest expense. This will give you the overall profit. How do you calculate the overall profit? The profit or loss from the sale of shares, and interest is always expense because either interest expense or opportunity cost. Any doubts up to this discussion? In the long position transactions, in the long position transaction, are you able to get the point? One more thing, being in the spot market, share market, you might receive dividend also. During this period, you might receive dividend income. That also may be your income. Overall profit, how do you calculate? Your sale price minus purchase price minus interest expense and plus dividend received, if any. Dividend received, if any. Write down this table and write the overall profit calculation and let me know if you have any doubts. Okay, once it is done, let me know. Done. Okay. Any question on the long position transaction? Now let's go to short position transaction. Short position transactions. Any questions before we start this? Because the short sell is vital. It's confusing. It can be complex, but beautiful. Very nice concept. Please confirm. No questions so far? Okay. So, first thing first, you know the meaning of borrowing money. It's definitely possible. You borrow money from the bank. Can you borrow commodities? Then we'll think about, can you borrow shares or securities? Okay, tell me. Before that, I'm getting one question. In case of own funds, also interest will not come. Interest will not come, but opportunity cost will come. Opportunity cost will be an expense that will come if it is own funds. Fine. Is it clear? Yes. Now answer this question. Have you heard of borrowing commodities? Have you heard of borrowing commodities? Have you done anywhere in your life? Have you borrowed any commodities? Not money. Have you borrowed commodities in your life? Have you borrowed any products, commodities, things? Yes. Simple example I'll give you. When you are in schools, when you are in schools, you might have been writing in pen, pencils. Even now, when you go to classes, what would have happened? Your pen might not be working. What you tell? You ask your friend, give me the pen. You use it. Whether you give it back or not, that I don't know. But definitely, you know the concept of borrowing in commodities. That is, you use and later you give it back. So you have used your friend's pen, pencil, erasers, mobile phone, their book, maybe their car, their two-wheelers, you have given back. So there is concept of commodities. In some places, some cases, you also borrow somebody else jewelry and give it back. In some cases, I've seen people borrowing clothes from dry cleaning stock by the dry cleaners and all, and then you borrow coats, then you repay the coats. I mean, give it back the coats. So there is concept of borrowing in commodities. Now, before I tell the process, I'll tell you that list of transactions. I will tell you the list of transactions. Let's see what will happen. And then we'll list down in a neat manner. Okay. Now, let's say there is, you borrow 1 gold, 1 gram gold. You borrow gold, 1 gram. You borrow gold, 1 gram. You go to the market today. You go to the gold market. You sell, because you have gold, you sell at today price. You sell at rupees, let's say 5,000. I don't know the price. I'm just taking example. You sell at 5,000. So you receive money. And what do you do with that money now? You deposit in bank 5,000. After 1 year, after 1 year, this deposit matures. Let's say 10% deposit. Deposit matures at rupees. 10% on 5,000 means 500. 5,000 plus 500 means 5,500. Deposit matures at 5,500. Now you have 5,500. Now what do? You buy the gold after 1 year. Let's say at the price prevailing at that point in time. Let's say it happened to be 4,900. And you have the gold now. Now you are going to repay 1 gram of gold. So you borrowed 1 gram, you repaid 1 gram, and you got a profit of this. Your ultimate selling price is 5,000. Your buy price is 4,900, and you have an interest also. Interest income you earned of 500. So total profit happens to be for you 600 rupees. Total profit for you 600 rupees. We'll write this example. Don't worry, we'll write this example. First, do you have any question relating to these transactions? Anything not possible practically? Any of these points? Anything not possible practically? You borrow gold, you sell in the gold market, deposit the money in the bank. After 1 year, you get back the money. Go to the gold market, buy the gold using the money you have. You get the gold, repay it back to the person who have. Anything not possible practically here? Tell me. Anything not possible practically here? Any questions you have? I'm getting one question. Always cash price of gold will increase? I don't know. Who told that cash price always will increase? Not necessarily. I've given you example of 1 year. It might be after 1 day. It might be after 2 days. Every day that price will not increase. Gold price can come down also. Okay. Write down this example. Write down this example. Just an illustration. Just an illustration. Today you borrow 1 gram gold. Today you borrowed 1 gram gold. Go in the gold market, you sold at 5,000. Okay, let's do one thing. Let's write the transactions, illustrations, whatever it is, illustration. Okay, transactions today. Borrowed 1 gram of gold. Sell 1 gram of gold in gold markets at rupees 5,000. Then whatever money you receive, deposits rupees 5,000 in bank at the rate of 10% per annum. After 1 year, deposits matures. How much? 5,000 plus 5,000 into 10% into 1 year. So 5,000 into 10%, that means 5,000 plus 500, which is 5,500. Then buy 1 gram of gold at, let's say, market price 4,900 and repay 1 gram of gold. The overall profit of selling price 5,000 minus buy price 4,900 plus interest income 500, so 600 rupees. Overall profit you made. This is short position. When the market price coming down, also you made a profit by selling it today and buying it later. Any questions in this? Is it done? Shall I go further? Please confirm. Clear. Okay. Now here, the person who borrowed by taking short position, he made profit. No doubt about it. The person who lent gold, did he lose anything? Person who lent gold, did he lose anything? Earlier he has 1 gram of gold. Now also he has 1 gram of gold. So physical commodity wise, he has not incurred any loss physically. But 5,000 rupees earlier now became 4,900. So he lost 100 rupees. But that would have anyway happened if you just hold the asset. If he just hold the gold without doing anything, he would have lost 100 rupees anyways. Even he has not lent it. He just hold it. Then also answer would have been same. So if the short transaction should happen, first point, borrowing is required. And whom will you lend, or who is the person who is going to take a short position, who is expecting the market price will come down? Now who is the person who is going to lend, who is thinking the market price will increase, who is taking long position. So once he gets back the security or once he gets back the commodity, his position is not affected. Because if he has taken a long position, earlier also he will have asset in his name, now also he will have asset in his name. But there are always questions. What if repayment does not happen? There is a risk of default. And when you transfer, some transaction expense will be there. Those things we will ignore it. In general, transaction expense we ignore it. But one thing can happen. If it is a depreciable asset, if it is a depreciable asset like car, you use it for 1 year, you use full 1 year, you use, then you give it back. Take back your car. This is your car only. No, the depreciation decrease in the value of the asset. For that, you have to compensate. Anyway, we'll write down all the sentences. So first, let's write down the transactions in short position. Transaction in short position. So transactions today. First, borrow commodities or securities. Borrow commodities or a security from a person who is ready to lend it. Who is ready to lend. And who will be ready to lend? A person whose intention is to hold the asset. That is long position. Will be ready to lend it. So first point, borrow commodities or securities from a person, from a person who is ready to lend it. Just wait for a second. So borrow commodities or securities. Just 1 second. I think the internet is streaming, buffering. Just 1 second. Let it be stabilized. Okay. Is the internet back now? Is it clear? Is the voice audible and all now? Is it smooth now? Is it fine? Is it okay now? Can you please confirm? Is it fine now? Is internet okay now? Please confirm. Yes. Okay. Good. Let me let me read what I've written. borrow commodities or security from a person who is ready to lend it. From a person who is ready to lend it, a person whose intention is to hold the asset. A person his intention is to hold the asset, that is long position, will be ready to lend it. Will be ready to lend it. Now, second point, sell the above commodities in the spot market. Sell the above commodities in the spot market. Sell the above commodities in the spot market. Third point, deposits deposits the money received. Deposit the money received in money market. Money market means in deposit in bank you deposit, but you can deposit anywhere. You can deposit in bonds, you can deposit in commercial papers, you can deposit in mutual funds, debt mutual funds, risk free security anywhere. That's why I don't say bank deposit, I just say money market. Done? Will I take this out? I will take this out. I hope you have done. Okay. Now, transactions after holding period. After holding period. Say 1 year. After holding period, say 1 year. After holding period, say 1 year. So what and all you are going to do? First thing, deposits matures along with interest. Deposit matures along with interest. Second, utilize the above amount to buy security in the spot market at the price at the price prevailing. At the price prevailing. At the price prevailing. At the price prevailing. Next, repay the security to the lender. Repay security to the lender. Okay. So repay the security to the lender. Repay the security to the lender. So lender position is not affected. Lender position is not affected because his intention was to hold. Lender position is not affected because his intention was to hold. His intention was to hold. Please note, transaction charges and risk of default is ignored. Transaction charges and risk of default is ignored. Transaction charges and risk of default is ignored. What is transaction charges? When you buy the shares, brokerage will be there, stamp duty will be there, demat charges will be there. Like this, when you borrow the shares or when you borrow security and when you repay security, you have to pay some amount also, because other person is taking risk, he is lending you, but that is transaction charges, so we ignore that. One more point also you write down, and okay, we'll write down, but let me know you have done till here. Shall I erase it out? Is it done? Please confirm. Shall I erase this out? Please confirm. Shall I erase this part out? Is it done? Okay, done. I'll take this out. So repaying while repaying the commodities while repaying the commodities, while repaying the commodities, any depreciation in the asset should be compensated to lender by borrower. While repaying commodities, any depreciation in the asset should be compensated by the lender to the borrower. By the lender to the borrower. Okay. Now, like you understand depreciation, like if you use car, 1 year if you use the car, asset value would have depreciated because you use more and more. You have to compensate that, how much ever is usage. Due to holding the asset, basically. Due to holding the asset or due to usage. That's what you call as lease rental also. When you use the asset, when you use somebody else's asset for your purpose, you pay lease rental. You have to pay that compensation. Okay. Now tell me this. If I apply to shares, you borrow shares. Now, whether borrowing shares are possible or not, we'll discuss slightly later. Assume you borrow shares. Assume you borrow shares and later you repay the shares. Now, when This during this period, if dividend is paid, during this period, if dividend is paid, can you tell me the share price would have gone down or would have increased? Theoretically, other things remaining constant, what is the impact of dividends on the share price? The share price would have reduced. But if you are a shareholder, even if the share price reduces, you are not affected for the reason you receive dividend. So there might be a reduction in the share price, but you receive dividend, so your position would be unaltered. Your position would be unaffected. Correct? Now, because you have lent the share to somebody else, because you have lent the share to somebody else, somebody will receive dividend on behalf of you. You will not receive. You are supposed to receive because you are the holder. If you continue to hold the asset, you would have received it. Think whichever way you want. That dividend belongs to you. So the borrower, while repaying the shares, he should give not only the share but also the dividend element. Should I repeat this anything, my dear friends? Please let me know. Should I repeat this? Any point related to dividend? Are you clear on the dividend aspect? Dividend was income when it was long position. Now, being a short position, you would have received the dividend. Now, dividend will be a repayment. Okay, let me give an example. Let's say Mr. A is the lender and Mr. B is the borrower. Okay, now the share price was rupees 100 when you lent it. Okay, and after the share price became rupees, let's say 95, you lent it, then you get it back. You lent and you repay it back, get it back after 1 year. So you will have 95 rupees with you. Even if you did not lent it, you would have had 95 rupees with you. Now you think, now you think you receive, there is a dividend in between to the extent of, let's say, 3 rupees. If you did not lend, there was no borrowing happened. Think from the holder perspective. How much would have been his position value? Value of security worth 95 rupees, dividend worth 3 rupees. His position would have been 98 rupees, right? 90 rupees share price and dividend 3 rupees. His position would have been 98 rupees. If he continued to hold the asset without lending it, he just hold the asset, share price 95, dividend received 3 rupees, his wealth, his portfolio is worth 98 rupees. If lending did not happen. Now that lending happened, 3 rupee was received by borrower because he is the shareholder, and if he gives back the share to you, you will receive only 95 rupees, you will not receive 3 rupees, which is not right. And also we learned in short position, any depreciation in the value of the asset should be compensated. So here, being a lender, you have the right to receive the dividend, but for the lending, you would have received it. Because you lent it to somebody else, he received on behalf of you. You are supposed to receive it. Therefore, while repaying, share coming back is not sufficient. A dividend also should come back to you. In other words, the position of the lender should remain same whether he has lent it or not. One second. Okay. Let me repeat. Let me repeat. Uh, the position of the lender should remain same even if he had not lent these shares. And if there is any loss happened because of this transaction, it is the responsibility of the borrower should compensate the lender so that his position is not affected by lending the share. By holding the share and lending the share, his position should remain same. By holding the share, he received dividend. By lending the share, he don't receive dividend. That needs to be compensated. By whom? To be compensated by borrower. Is this concept clear? We will write the sentences, don't worry. But is this concept clear? Should I repeat once more? I don't mind repeating it. But tell me whether did you understood? Any point of confusion you have? Is it clear? Any point, anywhere you are not convinced, get it clarified. Because later when you do problems, I don't explain this again. I say short position, dividend, payment, over. I will not repeat these things again and again. Basic when we do, things has to be stronger. So any point of confusion you have, get it clarified. I'll give you 10 more seconds for you to think. Understood. Very good. Let's write down. Important point, write down. The treatment of dividend in short position. 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 Okay, write down. During short position transaction, during short position transaction, during short position transaction, the position of lender, the position of lender should remain same as compared with as compared with as compared with the position as compared with the position without lending, that is continues to hold the asset, continues to hold the asset. That is the first point. Second point, now during short position, that is before repayment, during short position before repayment, dividend would be dividend would be received by dividend would be received by the borrower. Dividend would be received by the borrower because he will be the shareholder. He will be the shareholder as per register of members. It will be received by the borrower because he is the shareholder as per register of members. Register of members. Third point. However, the lender is the one who is supposed to receive dividend. Who is supposed to receive dividend. Lender is the one who is supposed to receive dividend. Supposed to receive dividend. But lost this opportunity. But lost this opportunity. Lost this opportunity. Lost this opportunity. Lost this opportunity because of this lending transaction. Lost this opportunity because of this lending transaction. Because of this lending transaction. Because of this lending transaction. Because of this lending transaction, this dividend this dividend should be compensated. This dividend should be compensated by the borrower. This dividend should be compensated by the borrower to the lender, by the borrower to the lender in the form of cash. In the form of cash. In the form of cash. Okay. Let's write down the process. Now, list of transaction. In short position today after holding period, let's say 1 year. Today after 1 day holding period, you do transaction in spot market and transaction in money market. Okay, so in spot market, what transactions you do? In spot market, you're going to borrow and sell. You borrow commodity, borrow shares, and then you sell. Now, can shares be borrowed? We'll discuss later. But like borrowing commodities, as of now, borrowing in shares also possible. Now, money market, you're going to deposit. After holding period, deposit matures. And borrow and sell, now you use this money and purchase. So you purchase, you buy the shares and repay. Now, market price can go up, market price can come down. If market price go up, you make loss. Short position, you make loss. If market price comes down, you make profit. In both cases, you will get interest income. And during this period, if you receive during this period if you receive any dividend during this period if you receive any dividend, that dividend should be paid to the lender. Dividend should be paid to the lender. In general, how do you calculate overall profit? Selling price, which is taking place today itself, minus the buy price, purchase price, then plus interest income minus dividend paid. Previously, interest was expense, dividend was income. Here, reverse. In short position, interest income and dividend paid. That overall profit is the profit or loss for the person who is taking short position. Who is taking short position? Okay, is it done? About short position and about long position. Short position transaction today after holding period. Short position transaction today after holding period. What is the profit or loss when market price goes up, when market price comes down? What is the treatment of dividend? What is the treatment of interest? And when do you make profit and when do you make losses? Good, done. So what is left out now? We understood long position, we understood short position. Short position meaning we have understood, and then by borrowing securities, by borrowing shares, by borrowing commodities, you can do it. But still, you may not have convinced how to borrow the shares, how the short position takes effectively in the markets, how the short position is done in the market, practical aspect of short selling in the market. That we will do a separate discussion tomorrow. Not today, a separate discussion we will have on short selling practically. I will show you practical aspects, how it is possible. And you'll understand a little bit about trading also. Many more short sellings are possible because short selling in future is different. Short selling in option is different. Short selling in spot market is possible. So many short sellings are possible. But let me give you some idea about the basic aspects in the tomorrow's session. So tomorrow I will have two sessions. One session will be for the stock lending mechanism, short selling practically, which is open for all. Maybe about half an hour, 20 minutes, we'll have that session. And then we will have the session, our regular classes will continue after that. So tomorrow we will start the session at 5 o'clock. At 5 o'clock, practical aspects, including today's revision and practical aspects of short selling will apply. We will do practically, we discuss how short selling can be taken in the place in the market. And then after that, we will continue with our regular classes. So my regular students, two links will be provided to you. Please be careful. One for the 5 o'clock session, which is for short selling, open for all. Then 5:30 onwards, only for our regular students. It will not be public. I hope things are very clear. Practice more. I will share the MCQ question like every day on my Telegram group. For those who want to write the MCQ question, please join my Telegram group. It is available in the description. The Telegram link is available. You can click it. There I'll share my everyday MCQ question I'm sharing for revision purpose. On today's session also I will share it. So that's it for today. I hope you have learned something new and something interesting and which is definitely going to be useful to you. We'll stop at this point. We'll see you tomorrow at 5 o'clock. Till then, have a nice time. See you. Bye bye. Good night.